world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Brett King, founder and executive chairman of Moven, one of the world's original digital banks, and Lex Sokolin, global head of fintech at ConsenSys. Lex and I discussed Moven's recent announcement to shutter its B2C business on episode 170 of Rebank, and we're happy to have the opportunity to connect with Brett directly to discuss the decision in more detail. Of particular interest in this conversation are Brett's learnings from 10 years of running Moven about B2C versus B2B as a digital banking strategy, the missing pieces in the current US and European challenger banking business models, and where the space will go from here. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Brett King and Lex Sokolin. Brett King, welcome to Rebank.
It's good to be back.
It is. It's good to connect. I think this is probably the third time that we're connecting on Rebank.
Sounds right.
And once on Breaking Banks, I think.
I got to catch up to you. I got to bring you back onto Breaking Banks.
Well, we'll do it. There's a lot to talk about these days.
No, we should do a joint podcast. We should do like a special for our listeners, like a combined Rebank Breaking Banks. That'd be interesting.
That'd be fun. Let's
do it.
We've also got Lex Sokolin, who is very near and dear to us at Rebank, and as I'm in the habit of telling people, one of the smartest people I know. So glad to have him involved also. I'm sure we can draw it out a little bit as we go, but I think Lex will add an interesting angle to this conversation. So, Brett, I wanted to pick up with you, apart from just making up for lost time, but you at Moven have had some interesting developments recently, specifically announcing that you're going to wind down the B2C business. So, interesting subject matter to dive into. I think it'll be clear as we go that this is actually a great move for you guys. But maybe in your own words, you could recap for us what's been going on.
So, we had decided to split the two businesses, the direct-to-consumer business and the enterprise business, about a year ago, and we had raised some initial interest in sort of funding a relaunch of the direct-to-consumer business. The reasons for this were fairly evident, but if you look at investor thesis at the VCs we're engaged with and the private equity firms we were engaged with, they either had a thesis of investing in high-growth consumer fintechs or in enterprise fintechs. You don't get VCs generally that want to invest in a hybrid. So despite all of the talk that we hear about being interested in different business models and so forth, the investment thesis really was split along those two lines. So the longer we stayed as one company or one entity, we had limited options in terms of, continuing to raise money, because if you go to enterprise guys, they weren't interested in the D2C metrics, direct-to-consumer metrics, and vice versa. So we made the decision to split off the D2C business, raise some funding separately for that, and deal with them as two separate companies with some common IP. Essentially, our consumer business would have been an enterprise client for us.
Quick context for everyone who missed the first couple times we connected. Moven was founded in it was like 2008, 9, something.
Yeah,
right?
so it was August 2010 was when we registered the domain Moven Bank, back in August. I think it was August 8th, 2010, and then by November we were starting to put the team together. The company was officially formed, and our first seed round, or our friends and family round, was completed by April 2011.
So that's, I think, actually when I first met you, either it was 2010 or the summer of 2011 during those venture pitches, and hearing the vision for the digital bank and the gamified bank, and lots of interesting concepts that were really ahead of their time. And at the time I was building a B2C robo-advisor from scratch, and in 2010, none of these words existed: challenger bank, neobank,
Correct.
fintech, robo-advisor. This was all just, hey, you failed out of a career on Wall Street and you're doing something weird. What's wrong with you? So I guess my question is, to the earlier point you had of enterprise VCs and direct to consumer VCs not understanding the hybrid bet. When do you think it all started to kind of click, like these themes and your ability to tell the story? When do you think people really started to grok what these things meant?
Yeah, no, that's a good point, and that's actually a pretty important storyline in respect to why we've ended up in the place we were. 2010 was very, very early in the challenger bank process. We were clearly the first mobile-focused challenger globally. At the time, you had Bank Simple around, you had Fidor in Germany, but that was pretty much it. There wasn't really much in the way of challenger banks, certainly none that focused on a mobile-first operation. So we did a bunch of firsts associated with that. So we had the first online account opening within an app for a bank account anywhere in the world. We had the first real-time receipting experience, which we built. We deployed the first contactless capability. Even prior to Google Wallet and Apple Pay, we had these contactless stickers you could stick on the back of your phone. We used the homepage space of the mobile app very differently for the first time, and created a design pattern that you can see today in N26, Monzo, Starling, using the homepage to communicate more about people's relationship with their money. All of those were things that we sort of pioneered in those early days, well before any of the other mobile-based challenges had emerged. And so, it was a very exciting time. You may also remember we didn't actually launch with the bank account. We launched with something called Cred Score. Do you guys remember that?
It was before my time.
Yeah, it was very, very early.
Yeah, I remember the gamification aspect as the one thing that stood out, and that really appealed to me because one of the things that Mary Meeker articulated really well in her 2017 deck and just stuck with me is that all the interfaces that you see today in fintech and banking are video game interfaces from the 80s. They look like it, they feel that way, they have the score, they have the number, they have the charts. I mean, if you look at Robinhood, it's literally like Space Invaders. So I think that was definitely ahead of the time.
So we had, by 2014, we had 250,000 customers, and things were looking pretty good in terms of the growth, but we just couldn't raise money for the challenger bank back in those days. There was a little bit of money around, but 2013, 2014, people were still asking the question whether challenger banks were going to make it, whether it was real, and it was really tough to raise. So we started to get inquiries from banks that had seen what we'd done, were very interested in our design approach from a user interface perspective, and we're asking to license our tech. Now, we resisted that, but essentially by 2015, we were having to take those deals, late 2014, early 2015, for purely revenue purposes, just to keep the business funded and keep it going. So the first major deal we did was with TD Bank in Canada, and then Westpac out in New Zealand. These were the first couple of deals, and that took us in sort of this different direction where we're now having to support enterprise software clients as well as build a direct-to-consumer business. But to sort of give you guys a bit of a rough idea, if you look at the Series C for Monzo, which was 19.5 million back in February 2017, and N26's Series B, which was June 2016, for both of those guys in terms of their raise, we had more customers than they had when they raised those amounts, but we couldn't do raises fundraisers of that sort back in 2014. Just it was no one willing to fund
because the market wasn't there.
Yeah.
Yeah.
And so pragmatically, we went after the enterprise business. And, for a small team of, at the time, I guess we probably had about 35, 40 employees. For that size of a company to be taking on now an enterprise business supporting major banks, as well as trying to do D2C, we probably bit off more than we could chew. But pragmatically, we went after the revenue.
In terms of the stack, like the infrastructure partners that you were working with, can you just describe how you, I guess, got into offering, FDIC insured accounts, and then how, if at all, those partnerships have evolved over time?
It's actually a really interesting story. We started off with Bancor and a processor called TXVia. I don't know whether you guys remember them, but this was built by the same guys behind Money 2020 and Neil and Jonathan, TXVia, and they were going to be our payment processor because we wanted a real-time processor. A core component of our gamification design was this real-time feedback loop at the point of sale. When you tapped your phone, you got this receipt experience, and it changed your spending behavior through messaging, and some psychological behavioral research that went into that as well. So TXVia and Bancor were our first partners, but TXVia was acquired, like about 6 weeks out from our launch. TXVia was acquired by Google, and Google shut us down because at that point we weren't live, right? Because they saw us as a competitor. And so then with no payment processor, Bancor's like, well, you guys don't have a payment processor, so we can't exactly help you. So by the time we got a new payment processor, which was FIS, Bancor was inundated with both the Google Wallet and PayPal debit card at the time. And they were like distracted by that and they weren't really as enthused as they were early. So we partnered then with CBW Bank out of Kansas here. CBW is run by a guy called Suresh Ramamurthy. Suresh is an ex-Googler. He bought a bank for this very reason. So they became our core banking partner. But of course, we ran the entire front end of the bank. So we did all the customer support. We took, we onboarded customers. We had our own bin from MasterCard. So we ran the entire front end of the bank, but, with FIS as our processor and CBW at the back end. And frankly, after we knocked off the rough edges in the first 12 months, 18 months, that relationship worked very well, up until today.
So if you fast forward from the 2010 founding to now, 2020, are you more bullish on the B2C digital bank model or the B2B model?
Let me answer it in two ways. First of all, I'm very bullish on the enterprise model because obviously that's how we've pivoted. And from a profitability and revenue perspective, that's clearly where we have been making most of our money over the last few years and where we see the biggest growth opportunities. Even now within coronavirus, with the coronavirus thing, the push to digitization, the need to engage customers with more than just self-service capabilities, all of that is changing right now. There's huge opportunities there. But, when I look back at the early days of Moven on the direct-to-consumer side, I was very idealistic. I wanted to have I wanted to change the world of banking. I wanted to redefine the bank account in terms of what your expectations of it were. And, when I would go to pitch, and I don't know if this was part of the pitch I made to you, Lex, but we would talk about, being the Facebook of banking back in 2010 and so forth. It was very rough and raw back in those days. But, I think the intent to change the way people thought about their money, the way they experienced the utility of banking in their daily life, I think that's still a very admirable intent. And, so for us, that is actually wrapped up in our decision because ultimately, how many lives could we influence with Move? And even if we were successful in the US and launched it in the EU and things like that, maybe 20 million customers. But, right now today with Moven being on a distributed basis, sort of trying to get our tech into as many banks as possible, as many handsets as possible, we've already got about 50 million users of the platform globally, on a distributed basis. And so we feel like that's a better way to influence sort of global financial wellness and, core expectations around what a bank account should provide for you. Ultimately, we feel like we can do more on the enterprise side, and from a purely business perspective, we get a lot more return out of investment in that side of the business right now.
There's an interesting piece of advice in there, which is don't listen to VCs about what your business strategy should be.
Yeah.
Basically at no point of time other than as a sanity check of where the market is, but not about where the market should be. The 2020 fintech B2C world is so drastically different from what was there a decade ago with, these kind of vertical fintech champions levered up, $1 billion of funding, sort of careening on issues around customer profitability. But the path to getting there, and I think a lot about why investing worked as a theme in the US and neobanks didn't, and then why that flipped.
Yeah.
And I moved to London about 3 years ago, and it all kind of clicked for me where nobody in Europe really cares that much about Nutmeg or digital wealth because they've got pensions and sort of a much more conservative investment atmosphere. But for banking, the problem set is very different than Americans. In particular, if I go from London to Paris and I swipe my card, I have to pay 6% bank tax on every sandwich I buy in terms of the FX fees. And people travel because it's all so close. And so I felt like there was a real killer use case. There was a reason why somebody would download Revolut, because it's not just a better interface, but they would save money immediately getting the app. And in the US, just the culture didn't necessarily support that use case. And it took a while for folks like, Chime and Moneyline to start embedding credit in a very kind of integrated way and find the American use case. And I'd love to hear your views on sort of, was there something missing from the American consumer that made it easier to do neobanking in the UK and in Europe?
Yeah, I think that's a pretty interesting point. I think in the US, you did need regulatory support. You still need better regulatory support in the US. Like we just heard yesterday, Monzo applying for a banking license in the US, and that process is going to take them 2.5 to 3 years. Compared with the process of getting a fintech banking license in the UK, it's radically different. So the regulatory environment is very different. But in terms of the systems in the US, you still have dramatic dependence on, and you have underlying systems that restrict your ability to really change the dynamic on banking. So you don't have real-time money transfer, unless you're using a startup like PayPal or Venmo, right? You have an ACH system that can take you 5 days to get money from one bank to another. It's literally faster for me to write myself a check from one bank account and do a remote deposit capture using a camera from another bank account to transfer money than it is to send it electronically from one bank to another. And so you've got these embedded behaviors in the US around checks and cash and so forth, sticky behavior that requires sort of large institutional momentum to change. And the existing players were very resistant to that. Even back in 2016, NACHA, who is the national association that runs the ACH business in the US, the bank-to-bank payments network, even back then, the big banks were stopping NACHA from adopting real-time payments mandates, right? So it wasn't until the Fed put that in place, just last year, and now they're talking about a 2024 implementation. So some of the plumbing in the US just doesn't allow you to be as inventive as you could have been in the UK or the European Union either. So I think there's a little bit of that sort of reinforcing the incumbent behavior in the US system that's hard to break, but also combine that with the regulatory environment and the fact that when you're going to investors in the US, you've got to have the big numbers to be able to raise the sort of money you need to grow challenges, but you need to get that growth first. And that growth just requires a lot of money and focus on marketing and acquisition in the early stages. So if you don't raise enough capital in the early stages in the US, you'll never get to that critical mass because those other things in the system are sort of holding you back a little bit. That's probably my thesis.
So apart from that, extra $1 billion raised across a few rounds for Moven's B2C business, what else could have contributed to a faster scaling, more economically viable B2C bank? And I ask this not necessarily to focus on Moven, but to extrapolate your wisdom as we think about other banks in the market.
Well, ultimately, as I pointed out from, N26's raise and Monzo's raise, the biggest point was timing. We were just too early. If we had started Moven in 2013, we would be the biggest challenger in the US, I think, because of the funding cycle. So, it was a timing issue. We were just 3 years too early on the cycle. And in terms of, we were always underfunded for the direct-to-consumer business in those early days. And I'm not using that as an excuse, but that was just a maturity of the market. What could we have done differently? Look, I think if we had decided to split the business earlier, if we had been able to if we thought a little differently about the tech stack in terms of the way we built it, and we built it out initially, with a bit more flexibility, instead of to have to sort of rebuild our tech stack sort of halfway through to cater for the growth in enterprise. Because the first enterprise solutions we did were just taking Moven's direct-to-consumer thing and copying the components we needed for enterprise clients. Whereas now we obviously have full API layer, SDK. We've developed out the stack to make our enterprise business more flexible. So if we'd had some flexibility in the tech stack, it would have required less investment in enterprise. We could have continued to work on D2C. That might have helped, but ultimately we were just too early. It was
from a product set standpoint. I mean, and I don't know, maybe we switch gears and think about today specifically rather than 2010, 12, 14, whenever it may have been. But based on where we are now, like real-time notifications, free checking and debit, is that plus a multi-billion-dollar marketing budget enough to amass 10 million plus users? Or, do you need to fundamentally be, I don't know, like innovating around lending or around, I don't know, like genuinely creating new products, bringing in investments in ways that create like a more comprehensive offering? Where are we now, and what needs to change in order for Chime to become Chase?
Right. So the next phase of this comes around what you'll hear often referred to as embedded banking. Right. And so the real change here, mobile started us on this route, and part of the reason that the explosion in challenger banks didn't occur back in the 90s when the internet arrived is, first of all, you couldn't really differentiate that, well in terms of internet experience versus a traditional bank. primarily because the technology just wasn't there, but also there were design constraints, obviously. Mobile changed the rules because mobile gave you contextuality. It gave you the ability to do stuff on the move, on your phone. So there were design things you could do that you would never have done in a branch-based bank, sort of morphing to the internet. Right. So mobile gave us ways to design banking very differently. But the next phase of this is when we start talking about personal AI. So the development of Siri, Alexa, Bixby, these technologies that that will give us more engagement with our money via voice, and then of course augmented reality, through smart glasses and so forth. So over the next decade, you're going to see a lot more design focus on the way a bank account can embed itself in your life and adapt to your needs very intelligently. So this is the sort of era of the smart bank account. And there's still massive ability to differentiate that sort of day-to-day banking experience by surfacing the utility in predictive ways based on context like geolocation or some sort of behavioral trigger that you admit.
Are there any tangible really examples of like what that looks like in the consumer's life?
One that we've got, for example, built into our enterprise stack, and we never had the chance to deploy it in the direct-to-consumer business, is sort of contextual credit. And so there's two examples that I give you. One is that when we get people to save money within the Moven sphere, we don't use a budgeting methodology. We use a psychological behavioral model. And so we talk about velocity of savings and trying to change the way people save. So instead of sort of building different buckets, the envelope method, different buckets for different things you're saving for, we collect that, put that all together and show you all the stuff you're saving for and try to increase your overall velocity to build your savings pool. So then you've got choices as to what you can do with your savings. So that's a sort of a psychological approach to money rather than, the budgeting methodology, which isn't particularly successful anywhere in the world. Only about 15% of people are successfully able to save money using budgeting. So that piece. But now you've got a wish list. All the stuff that you want to buy or you want to save for, we know. So now we can start to anticipate your need for credit based on your intent to buy. So now if you want to buy a bicycle or a new iPhone or an N95 mask, we can anticipate that and sort of start to build for that. So that intent to buy and how it connects with credit, that's a very important relationship because we can manage the trade-off between using your savings for that or accessing credit and see that in the context of financial well-being. So that's a fairly new approach. But I'll give you a really simple example. You walk into a Sainsbury's in the UK and, you normally spend, or a Tesco, you normally spend £400 on your groceries. That's a lot, isn't it? Maybe say 300. And today we know that you've only got £150 in your wallet or in your bank account. So at that point, rather than waiting for you to fill up your cart, go to the checkout and be declined because you don't have enough balance, as you walk in the store, we can offer you credit. And we can say, hey, it looks like, you don't have enough money to complete your typical grocery spend today. We can give you an extra £150. This is the fee. It's $5 fixed fee if you pay it back within the next 30 days. And, your salary comes in 5 days, so you're good. Now, that circumvents credit card. You don't have to apply for a credit card. It's sort of this instantaneous ability to solve the problem that you have in real time based on a number of data points. And so it's that sort of way we think credit is moving. And if you look at models like Affirm, point of sale financing and stuff like that, these are very early evolutions of this sort of contextual credit movement that's coming. So there are some pretty good examples on the credit side where I think for traditional banks, they're going to find that much harder to make those sort of moves than challengers would. You think about going into a traditional bank like an RBS or a Chase and pitching them on this idea that's going to essentially eliminate the need for the credit card product. It's a hard sell.
So if you think about, you've covered a bunch of trends across embedded banking and banking platforms. And if you think about those trends coming together, and I'll throw in Google and Apple into those and Ant Financial sort of just to boil the pot fully, Is there, to me, you can tell this is a leading rhetorical question. To me, those are winner-take-all markets. Is there room for the long tail of banks that we have in the U.S., the 10,000 credit unions and small banks, or is it just Plaid and Visa that own all of that?
Yeah. Look, I got into some trouble in Australia recently when I was down there before the coronavirus, obviously, where I told them that if they didn't really seriously change the way they thought about payments and the wallet and the experience around that they would all be using Chinese mobile wallets by the end of the decade, 2030. And that was a pretty controversial statement, got reported in the Daily Press the next day. Because, obviously, if you look at where we are in the scheme of the evolution of the way we pay, China's well ahead of the West right now. 2019 and Financial Alipay and Tencent WeChat Pay did $31 trillion in mobile payments in China alone. The entire plastic card market in the world, including Apple Pay implementations and Samsung Pay implementations of tokenized plastic cards, was 23 trillion. Right. So, like almost 2/3 the size of the Chinese market. So, as these guys start getting into Asia, there's there could be sort of this global movement around the mobile wallet. But ultimately, I think your day-to-day spending account primarily is going to be an artifact in the cloud, surfaced on your phone that you can get access to, when you're transacting on e-commerce using voice or, on your other devices. What we think about as our main bank account, that's sort of going to change. We're going to have this mobile wallet embedded in our world that's our primary spending source when we're going out to do that. We may have, different apps for finances, not in the respect of mobile apps, but in terms of core functionality for, maybe investing or getting access to credit, like a smart credit advisor or a smart investment advisor, sort of a money coach built into our world. But that for most of the world, by the end of this decade, their primary bank account will be a mobile wallet of some sort, a mobile purse that stores their basic day-to-day spending. Now, it could be fed from a more traditional bank account, but for many people, they won't need a traditional bank account in the sense of just somewhere to store their money and be able to pay at a store or online. And so what we think of as a bank account, I think, is changing.
Lex, what parallels are there in Brett's experience to yours at the B2C robo advisor that you started early on and eventually pivoted to B2B?
Brett, maybe I don't know the extent to which you've been watching the investment space, but for me as an entrepreneur in the digital wealth space, I kind of had my aha moment in 2016 and looked around and said, everything's the same. The problems that people face and how they're building companies and how the themes and the vectors converge are all very similar. And so just for context, I started a B2C robo-advisor in 2009, 2010. So about 2 years later after Betterment, and John Stein also started out of Colombia. And I started building my company in New York. The B2C play in digital wealth, you talk about banking and savings. At least with banking and savings, you can sort of pitch for a small amount of money and it's transactional and there are many more retail customers. With digital wealth, your pitch is give me all your money and 40 years later, I'll give you $20 million. But, I'm a startup and you don't know who I am and let's do it on the internet. And so the proposition, the sort of the value versus the ask is very asymmetric, and that's a very hard thing for young companies to step over, especially when the word fintech and robo-advisor doesn't exist. And so for about 3 years, we tried building the B2C approach, and it was very slow going. But simultaneously, what happened much earlier, and we had set up an RAA and we were working with custodians, is as we were working with custodians like TD, Fidelity, and sort of the equivalent of the Fiservs, the pent-up demand on the independent side just became very, very obvious. So the independents, of which there's about 6,000 registered investment advisors relative to the 10,000 banks and credit unions, the independents were very interested in private labeling the technology. And there was a moment in 2013 when the enterprise positioning, the private label an instance of a robo-advisor for your business, just sort of hit the vein in the media, just hit it became the thing that people wanted. And I had more incoming prospects for that in the first month of 2013 than me pitching the 3 years back. It was just really a tidal shift. And I think 2013 to 2016 for digital wealth, as a hybrid approach or as a B2B2C approach, really kind of went into the mainstream as BlackRock bought Future Advisor, and LearnVest was bought by Northwestern Mutual, and GemStep was bought by Invesco. And so our company, which was Advisor Engine, was funded by WisdomTree. So there's sort of this rush in people's imagination, and I think that's very symmetric with what happened in banking. It's symmetric with what's happening in lending with OnDeck and Kabbage and so on. And I think, it's kind of how you build the business. But deep in there, I do have this kind of dissatisfaction of like, it does reach more people.
That it hasn't been as revolutionary as possible. Yeah, I get what you're saying.
And if I look at today, I don't see much difference between Revolut and Robinhood, to be honest. I think it's just customer audiences being pitched, lowest cost product. When I look at that stuff, it just feels so transactional and marginal, and I don't buy the sort of Amazon of banking story that's being pitched.
Yeah.
And I think I think there's a missing piece in terms of how the financial product is manufactured. And obviously for me, the next interesting thing is decentralized finance. And, that's where I'm focused on most of my time.
I think there's a parallel for us as well, because our direct-to-consumer experience building a challenger bank made it so much more credible for us to go and sell our capability on the enterprise side. Because people would say, well, we can see you've run a consumer business. We can see you understand the day-to-day issues of running a bank. And so but you did it differently. So that, we sort of treated our consumer business like a lab for enterprise in terms of product development and ideation. And so I think when we were going out pitching to new banks and clients, that pedigree was very useful for us.
So Lex pointed to this kind of almost turning point moment within the investments world where things went from, this like B2C exploration by new fintech startups to, very rapid industry adoption. So there's like a quick shift where suddenly everything went enterprise and like all the big players got involved. And actually we've seen tons of work, at the Schwabs and the Vanguards and the BlackRocks of like recreating a lot of these like what were initially like fintech concepts around robo-advice and pricing models, and really taking on board a lot of the early innovation. We haven't seen that in banking. We've seen some better apps, but fundamentally like not the level of digital innovation on the incumbent side that Lex just referenced in the investments world. And so I guess, my question then coming out of that, as you pivot to focus exclusively on the B2B side, is that turning point going to come in incumbent banking? Like, how big is the enterprise opportunity for you guys?
Because we had a direct-to-consumer business here, it really limited our options in terms of exposure into the US market. right? So now that we have announced, we're winding down the D2C and the customers are moving over to Varo Money, Varo has become an enterprise client of ours. Now that we've started articulating in the market, we've had a flood of inquiries from major players who said we would never have considered working with you before on an enterprise relationship because you were D2C. Once we were prepared to make that pivot, then the market has clearly been more amenable to our solution than previously when we were more perceived as, potential competitor.
Any parting words from anyone before we wrap up?
Despite everything, I've had a wonderful time with it all. And, for us, this move to enterprise, it was a very difficult move for me because when I started Moven, I wanted to change the way people thought about their bank account. I saw that as me building, the next big digital bank. And so it took me a while to really come to the realization that this pivot was the right move for the company, the investors, and, for our ability to make meaningful change more broadly. But it was a tough decision for me to sort of separate myself from D2C. I think primarily because we started this, and our brand globally was built as being that first mobile challenger. And I sort of felt like we might be losing part of our core sense of being by dropping the consumer business. But I'm not as fearful of that now. It's probably all in my head, and it was, but coming out of it, I wouldn't change anything. It's been, I've had an amazing experience.
Yeah, well, look, I mean, tremendous and very tangible contribution to the evolution of the space, both through Moven and also, through all the other thinking and writing and speaking that you do. So I'm sure that will continue, and perhaps even at greater scale now as you focus on enterprise. Brett King.
Thank you.
And Lex, thank you very much for joining us today.
Thank you.
Take care.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.